On the morning of September 16, 1992, currency traders in London arrived at work expecting a routine day. They were wrong. By the time trading closed that evening, the British government had spent £3.3 billion in a single day and lost. One man had made over $1 billion in profit. His name was George Soros. And what happened that day would change Britain's economy, humiliate its government, and rewrite the rules of global finance. Long before he targeted the British government, George Soros learned that survival was a matter of perception. Born Georgi Schwartz in Budapest on August 12, 1930, he was the son of a Jewish lawyer. In 1944, as Nazi forces occupied Hungary, his father secured false Christian identity papers for the family, forcing them into hiding. This experience forged a lasting rule. Survival required reading reality faster than anyone else, facing brutal facts head-on instead of relying on a false sense of security. In 1947, he emigrated to London, working as a railway porter to support his studies at the London School of Economics. There he studied philosophy under Karl Popper. Popper's ideas on human imperfection led Soros to question basic economic theories. He rejected the standard belief that markets are rational and self-correcting. To Soros, markets were driven by human bias and flawed perceptions. By 1992, after moving to New York, he was running the Quantum Fund, a highly leveraged investment firm. His strategy relied on reflexivity, the theory that investor beliefs change the facts, and those new facts then change beliefs. In October 1990, the British government joined the European exchange rate mechanism, a system designed to stabilize European currencies as a precursor to a single currency. Britain bound the pound to a central rate of 2.95 Deutsche Marks, committing to keep its value within a strict 6% band. Almost immediately, economists warned the rate was set too high. The British economy was weakening, sliding into recession. Yet, to keep the pound artificially strong within its mandated limits, the Bank of England had to maintain painfully high interest rates. This policy strangled domestic borrowing, but the domestic pain was secondary to political pride. The structural mismatch grew worse. British inflation was running at nearly triple the German rate, eroding the pound's real value. Meanwhile, Germany faced its own economic pressures. Following reunification, the German government spent heavily to integrate the East, prompting the Bundesbank to raise interest rates to combat inflation. This forced Britain to keep its own rates even higher to prevent capital from fleeing to Frankfurt. Locked in a system that ignored its economic reality, Britain's government refused to devalue or exit. Political pride anchored the currency in place, creating a perfect imbalance for a speculator to exploit. By the spring of 1992, the structural fault lines in the European exchange rate mechanism had become too glaring to ignore. Soros watched the British economy contract under the weight of high interest rates, realizing that the government's commitment to defend the pound at 2.95 Deutsche Marks was driven by political pride rather than economic reality. To him, the defense was unsustainable. To profit from this weakness, the Quantum Fund deployed a strategy known as short selling. First, the fund borrowed billions of pounds from London financial institutions. It sold those borrowed pounds immediately on the open market in exchange for Deutsche Marks at the overvalued pegged rate. If the pound collapsed as predicted, the fund would buy back the same amount of sterling at a much cheaper price, return the borrowed currency to the lenders, and pocket the difference. Stanley Druckenmiller, the lead portfolio manager of the Quantum Fund, had already begun executing the trade, building a $1.5 billion short position against the pound. When he presented the trade to Soros, the investor hesitated, not out of caution, but because the bet was far too small. Soros told him to go bigger, much bigger. By September 15th, the Quantum Fund had expanded its short position to a massive $10 billion. That same evening, Helmut Schlesinger, the president of the German Bundesbank, gave an interview. He let slip an offhand remark suggesting that certain European currencies might have to come under pressure and be devalued. To the markets, this was the signal that Germany would not rescue the British pound. Soros moved immediately on that signal. At 8 a.m. on Wednesday, September 16, 1992, London's trading floors opened to immediate panic. The British pound was already falling fast, sliding toward the absolute floor of its European exchange rate mechanism. Limit of 2.773 Deutsche Marks. To stop the decline, the Bank of England launched a massive buying campaign. At 8:30 a.m., the central bank bought £300 million of its own currency. It had no effect. Minutes later, they spent another £300 million. The intervention was useless. The selling orders from George Soros' $10 billion short position, joined by hundreds of other funds, easily overwhelmed the bank's purchases. By mid-morning, direct intervention had failed. At 11 a.m., Chancellor Norman Lamont took a drastic step, raising the official interest rate from 10% to 12%. He hoped higher returns would stop investors from dumping the currency. But the market recognized the move as panic. The selling grew more intense. Behind closed doors, the Treasury was running out of options and money. The Bank of England was now burning through foreign reserves at a rate of up to £2 billion per hour, throwing billions of dollars in marks into a bottomless pit. At midday, Lamont escalated the defense even further, announcing a second rate hike to an extraordinary 15%. It was a bluff the market refused to believe. Traders knew 15% interest rates would destroy the recession-weary British economy. They kept selling. By late afternoon, the reserves were spent and the defense was over. At 7:30 p.m., Norman Lamont stood before television cameras at the Treasury to deliver the final surrender. Britain was suspending its membership in the exchange rate mechanism and allowing the pound to float. The market reaction was swift. Overnight, the pound fell 15% against the Deutsche Mark and 25% against the US dollar. The day left the British government completely humiliated, having lost £3.3 billion of taxpayer money in a single day of trading. For George Soros and the Quantum Fund, the calculation was different. Their bet against the British state had succeeded, yielding a profit of over $1 billion. The political damage to the British government was immediate and permanent. Prime Minister John Major later described the exit as the worst day of his political life. The Conservative Party's reputation for economic competence was destroyed, initiating a downward spiral that ended in a landslide defeat at the 1997 general election. Yet, away from Westminster, a strange economic paradox began to unfold. Freed from the constraints of the exchange rate mechanism, the Bank of England slashed interest rates from 10% to 5.25% over the next 2 years. The sharply devalued pound made British exports highly competitive on the global stage. Economic growth accelerated and unemployment fell steadily. By the mid-1990s, Britain's economy was outperforming those of its major European neighbors. This unexpected rebound was so pronounced that economists and commentators eventually abandoned the dark label of the crisis, renaming the day White Wednesday. Today, the border between national sovereignty and global capital remains razor thin. Black Wednesday proved that market reality will always break political pride. As financial giants grow ever larger, we must ask, who truly governs? Share your perspective in the comments.